Hey guys, it's your boy Nico here from the Small Axe Podcast. I want to show you how to use your small axe to build a lasting empire. You see, not everybody begins their investing career with millions of dollars, a huge network of investors, or the knowledge necessary to become successful in this space, and that's okay. What I focus on here on this podcast is helping you hone your skills, sharpen your tools to become the best investor that you can be. Now, I want you to sit back, relax, and enjoy this show. If you have any questions or you want to reach out to me or the guest, feel free to do so. Love you guys. Okay, Small Axe community, what is going on? This is your boy Nico here, and today I'm just going to do a solo episode. I'm going to jive. You got to listen to me. You got to listen to my voice today, and that's it. Why? Well, I decided that it's time for a little bit of update, a little bit of my insight and my knowledge of what's going on in the market today, and to give you some hopeful vibes and some good vibes and good spirits to make sure that you guys are still looking for deals and still working hard. So we are facing some challenges in today's market, right? There is fear, and fear could be the biggest distraction or the biggest blockage or barrier to entering into anything we do in life. If we're afraid, we tend to avoid it. So if there is fear in the market of what is happening in the world today, or what is happening with real estate in general, then that can stop many people. But I'm going to tell you right now, ignore the fear, push through the fear, or work through the fear in your own pace and however you do that. If you believe in real estate as a good investment tool, right? If you believe that real estate is something that you should be investing in, then there is never a time to not be buying real estate. However, you obviously have to do it the right way. And today, some of the big challenges that we're facing as people looking to buy deals, right? We're looking to be operators, we're looking to be active, or even as a passive investor, we're running into some issues of higher insurance expenses, changing or rapidly changed cap rates. We had cap rate expansion, which may continue to expand. And we also have, obviously, the higher interest rates, because over the past year and a half now, interest rates have risen about 5%, which is crazy. Apparently, it has never happened before. I haven't been in the game long enough to see that, but this is apparently very unique, right? So what does all this mean? Higher expenses, properties are losing value, and interest rates are really high, so they're harder to cash flow. Now, when we're analyzing deals, when I look at deals, and I'm looking at deals every single day, and I'm turning over new leaves for looking at deals every single day because it's extremely important. When we are analyzing deals, we're going to stick to our criteria. We need to have X percent in cash on cash. We need to have X in equity multiple and an IRR, right? So as owner operators, this is what we look for. I also have to point out that as you're underwriting deals, your prices are going to change, because if the interest rate is so high, right? If the interest rate is 6.5% right now, where we are today, I'm talking June 9th, and there might be another rate hike coming up, or there might be a pause coming up next week. I'm not sure yet, but regardless, we look at the interest rate, we look at what interest rates are. And if the interest rates are high, we're not going to be able to cash flow as well. So that makes you offer a little bit less on the purchase price. Another factor that's hurting cash flow is insurance. And insurance has essentially doubled in many markets across the United States, and even more so in certain markets. Florida in particular has been hit very hard with insurance rates. Our insurance on our properties close to doubled, and we shopped around for it, and we finally got some decent quotes. So from now on, when you're underwriting, you have to factor these things in. Change your interest rate, right? Change your cap rate expectation going in and coming out, very important. And change your cash flow projections by making sure you are accurately measuring how much your insurance and other expenses are going to be. You still want to try to get that 6, 7, 8% cash on cash. you still want to get that 2 equity multiple, right? So how do you do that? Typically, you offer a little bit less, but the cash on cash isn't necessarily controlled by that. So you've got to control expenses and you got to push rents. And that's another issue. Pushing rents has been challenging as well. And people are saying that pushing rents is slowing down. That doesn't mean that rents are going to decline. That just means that we're not going to see 15% rent growth year over year for the next few years, especially if we are going into a recession. So you need to just be cautious of all of these things, but you should still be buying. Because here's the thing. If you're buying a property today and you're buying a property based on what meets your criteria, you're essentially getting a huge discount. I'm going to do a little I'm going to do a little sample for you guys. I'm going to kind of give you a little bit of a rundown of what I'm talking about. And if you are watching this on video, I'm going to share my screen. And if not, you could just listen and you're going to get a bunch of value right now anyway, regardless. So here's what I'm going to share here. This is a deal that I was working on. It's gone. So this is not a deal anymore. And I erased the name so you don't know what it is. This is essentially, so the purchase asking price was 3.55 million. And I'm coming in at 2.8 million. Now that is a 21%, about a 20% discount from asking price. Now here's what I'm looking at. I have a down payment of 30%, which could actually be 20% based on my underwriter who took a look at this for me. My lender, agency debt, they were pretty aggressive with this when they liked it. But the interest rate, a month ago was 5.85. Today is 6.5 essentially. So I put in 6.5%. I have 12 months of IO. I have 30-year amortization, right? Could I get more IO? Yes, but I have a 6-year hold here. Could be a 7-year hold. I typically model in a 5 to 7-year hold. And this is a syndication, by the way. So I have a 70-30 split, 7% preferred return. Typical acquisition fee 2% and asset management fee of 2%. The analyzer that I'm using is Chris Jackson's synthesis. If you want to get that, just hit me up with a text and I can message you and I can send it to you, or I could have him send it to you. Excellent analyzer. I love it. So now take a look here. We're looking at our member LP returns. IRR 14.07, cash on cash 6.13, average annualized return 17.43%, and equity multiple of 2%. So this deal is an excellent deal. Although we typically look for 15 IRR, there's no refi here. And if there's no refinance for 6 years, an IRR of 14 is incredible. 6% cash on cash, I would love that. I would do that all day. We have a 6.5% rate. This is wild. So this is actually a really good deal at a 20% discount if you were to get it. Now let's imagine this. Those of you listening, let's imagine that we had a 4.5% interest rate or a 5% interest rate, which is very likely. And if you don't think that a 5% interest rate is likely within the next 7 or 10 years, then you should probably not be investing in real estate. I'm going to be blunt about it. You have to believe that real estate moves in cycles. You have to be confident that things will be up and down. Just like we had a 2-year opportunity to get sub 3%, essentially zero interest rates, we will have some sort of an opportunity again. So we have to think that this rate could be 5%. Now, I'm not modeling in a refinance. I'm not going to do that, although that would obviously juice the returns as far as the IRR and cash on cash is returned, not the equity multiple. So we have our 2 equity multiple at a 20% discount right now. What I'm going to do is just change the interest rate let's make it a 5% interest rate. So if things get better in the next 6 years and we had a 5% interest rate, or rather, if we were looking at this deal from the get-go with a 5% interest rate, boom, our IRR without a refi is 15.73. Average cash on cash is 6.7. Annualized return 19.3, equity multiple 2.16. So this is a killer deal if we had it at a 5% rate today. And let me go to my expenses. I want to show you something over here. My expenses are extremely high. We have a 43% expense ratio, which is kind of low, to be honest with you, but the expense per unit is extremely high for this market. And why is that? Well, insurance is up. Insurance is crazy in this market. if you're looking at this video, you're going to see 2,500 a door. This is in a flood zone, but this is actually a serious opportunity that nobody talked about on this one, that you can, this will qualify for a LOMA certification. And I missed this opportunity, but this is a great opportunity because you pop in a LOMA certification, the discount is going to be about 13 grand a year, which is really going to juice returns on this particular property. So the point is this: if everything was better today, buying a property like this at a 20% discount is a sick, awesome, excellent deal. And we have to think like that. If you are a true real estate investor, you are getting a discount, even though cash on cash might be a little lower today, even though you got a model in for no refinance, which means the IRR is going to suffer a little bit. Even though this is the case, we have to look at things differently and holistically from a different point of view, that once rates do get better and once expenses do get better, because I do believe insurance is going to drop at some point too. Once these things get better, you are now owning a deal, a property that is just worth so much more. Oh, here's another thing. Another factor that I totally forgot to mention here is the cap rate. I have us exiting at a 6 cap. This is a 4.5 cap market. Yes, the market softened. Neil Bauer spoke about it, who I highly recommend listening to if you don't know Neil Bauer. He has shown that across the nation, cap rates expanded by about 1.3 or 130 basis points. So let's assume that this is now, let's say this was a 4 cap market. Now it's a 5.3 cap market. So I'm exiting here at a 6 cap. Things will get better, whether that's 5 years or 7 or 10 years from now, things will get better. And perhaps this is no longer a 6 cap at sale. Perhaps this is now a 5 cap at sale. And oh my goodness, year 6, we have, with no refinance, we have an IRR of essentially 20. We have average cash on cash, same 7.69. Average annualized return of 27% and equity multiple of 2.64 for a 6-year hold. This is incredible, guys. So you have to believe in the market to get deals done. You have to believe in this market to stay in the game. So there are cycles. There will always be ups and downs. Just make sure you're buying right. This is a 20% discount. This is an excellent deal at a 20% discount. I think this, real estate wins at the end of the day. So stay in the game. The main point is stay in this game. Don't be afraid. Just understand what you're getting into. Make sure you understand expenses properly. Make sure you leave yourself enough buffer to have some cash flow from the get-go. I'd like to have cash flow from the get-go for at least 5%, right? You got to have 5% or else there's no point. I mean, you could be investing in treasury bonds. So try to get 5% or high interest savings accounts. So the point is, stay in this game. Make sure you're kicking butt. Make sure you're out there hustling. Don't be afraid of a deal. There are certainly deals out there, and there are discounts now. And these discounts are not going to last, I'd say 6 to 12 months maximum, and it might be too late after 6 months. Once a recession hits and people start freaking out, things are going to change. So, and once interest rates start turning around, people are going to be more aggressive in real estate. I think the opportunity is now, within now and the next 6 months. Make sure you're buying, or make sure you are at least analyzing deals properly. So always be in touch with your lender. Always be in touch with your insurance team, and make sure you have the taxes verified properly with expenses. Make sure you're cash flowing around 5% for the first year or so. And make sure, don't freak out if the IRR says 12. Why? Because we're not modeling it for a refinance, and IRR suffers. IRR is the time value of money. So IRR goes up only if you get money back. It's quicker. And another thing, people have been boasting about their IRRs exceeding, the expectations, is because they sold it in 2 years or 3 years, and that juices IRR returns. So it is what it is. So make sure you're still in the game. Understand that these are deals. There are deals out there. Just make them happen. Don't be afraid. But the challenge is going to be get the expenses right and make sure you can get a loan, because getting a loan today is not easy. Reach out to your local lender, local banks, and or agency might be even better today. I'm looking more at agency these days. But it is what it is. So, all right. That's it. That's all I wanted to say. Make sure you're still in the game. Keep your head in the game. If you have any questions, I would love for you to reach out to me. I am always here to chat. I'm always available for you guys. And, let's take over the world one property at a time. Let's make things happen. Um, Give me a call, give me an email, and I'm always here for you guys. So, reach out to me. All right. Hey, Small Axe community. I would like to say thank you for listening to another episode of my podcast where we show you how to use your small axe to build a lasting empire. Now, if you liked what you heard, it would mean the world to me if you would subscribe, leave a 5-star rating, and write a review. Also, if you want to get in touch with me, go to my website at smalaxecommunities.com. Book a call with me. And until the next episode, keep sharpening those axes.